This is a big week for bulls with a lot of economic data in front of us, and it's important to remember that the economy has served a crucial function in stabilizing the market over the last now 2 weeks. It's important to remember that we have been chopping, grinding, and stabilizing, consolidating, a lot of different terms you could use to describe the range-bound nature of stocks for 2 weeks. I dropped the red light on stocks 2 weeks ago, and then the red light off crypto last week. I think it's time, given that we stabilized, saw vol come down substantially, we're normalizing in the market. The green light on stocks could be a short-lived one, but I'm going with it on a short-term technical basis as well as fundamental. Everything else holds for the moment. Let me tell you why. Firstly, today was crucial. We started off a big data-heavy week with a great piece of data. Manufacturing was light in the PMI composite, but the services were good, and that's what matters way, way more for the economy. We've known the manufacturing side is weak. And here's what was fascinating about the number as well, is that in that print, we also saw that on the manufacturing side, tariff concerns and inflation possibilities were baked in there. But for the services side, which is what matters, which is what has given the U.S. its leg up on the rest of the world post-COVID, was very strong. And as that happened, bonds sold off. This is very important now, and this is crucial to the analysis I gave last week as well. For the yellow light on bonds, a lot of people go, Powell's going to get dovish, that means lower yields. Not at this juncture. It doesn't look like that. Higher yields now, a full round trip, basically right where we were when Powell spoke. This is the direction you want. You really like to see this action. The fact that the 10-year yield down below 4.2 held its low from the week prior. Now, this is potentially a breakout for bonds. If yields go higher than 4.4, then I'll be turning the bond light red because that looks like we've moved past the growth scare. Now, there's always going to be growth scares, and eventually, of course, the economy is going to slow down in theory, but people have been saying that for years post-COVID, and we continue to surprise to the upside. So this morning's economic print helps add on to the previous 10 days of economic stabilization in which our numbers started surprising a little to the upside, or rather just not missing as much. Now, there are plenty of arguments to be made for an intermediate to longer term bear case, and I'm happy to do that. But for the time being, there's a couple particular areas on the chart that I'm watching for that suggest we could continue to the upside. Second is the dollar. The greenback stabilizing as well is a very big deal. I've talked about this a lot because the dollar is the tariff read-through. You have to flip the chart to the dollar there because the greenback has been a key way to read the tariffs. Remember when Trump got elected, the dollar went way up, and then it came all the way back down. And so even though some of the tariff talk in today's session was a little bit lighter, the dollar firmed. So that's kind of interesting because if when Trump got elected, the dollar went up, then that means that tariffs are associated with a higher dollar. But then today, the dollar went up, and the dollar's been stabilizing here, as many have described his tone on tariffs softening. So how does that make sense? It doesn't really, because the dollar is just about the U.S. relative to the rest of the world. Tariffs introduce some uncertainty for sure, but in theory, they could help stabilize the whole market as long as they just work their way through. The tariffs change an exchange rate, basically, and once the uncertainty is passed and they're locked in, there's nothing really new to add to the equation. Unless it really diverts the U.S. economic superiority, which is a hard case to make right now, the dollar should stay stable, and that's very good. That tells us the tariffs are getting priced in. The last part is the S&P 500. This is not a discussion about all-time highs yet, I don't think, because you got some really big candles in there. But what I have talked about is the election gap, and that's at 58.50. To me, all of this, so much of this rather, has been around policy and around the Trump administration that a return to that level for the SPX to 58.50 to close that gap seems like a great place to even the scale again for policy, and then we'll figure out what to do from there.